Have you ever bought something with money you did not actually have? How can someone buy things today and pay later? How does a small piece of plastic allow millions of people to spend money every day? When a payment machine says approved, who actually paid the store? Was it you? Was it the bank? Or was it the credit card company? Credit cards are used by hundreds of millions of people around the world. People use them to buy food. People use them to buy clothes. People use them to pay for travel. Some people even use them to buy houses, electronics, and expensive things. But very few people truly understand what is happening behind that simple swipe. Today we are going to explore how credit cards actually work. By the end of this explanation, you will understand something very powerful. You will understand how banks lend money instantly. You will understand how money moves across financial networks in seconds. And you will understand why credit cards can help people financially, but also trap people in debt. Let us start with a simple idea. A credit card allows you to borrow money. When you use a credit card, you are not using your own money immediately. Instead, a bank pays the money first. Later, you repay the bank. Think about a simple situation. Imagine you go to a restaurant with a friend. You finish eating your food. When the bill arrives, you realize something embarrassing. You forgot your wallet. Your friend says something kind. "Do not worry. I will pay today. You can give me the money later." In that moment, your friend becomes a temporary lender. Your friend gives you a short loan. A credit card works almost exactly like that situation. The bank becomes the friend who pays for your purchase first. But unlike a friend, the bank is running a business. The bank expects to be repaid. And sometimes the bank charges extra money for lending that money. That extra money is called interest. Now let us talk about something very important. Every credit card has something called a credit limit. A credit limit is the maximum amount of money the bank allows you to borrow. Imagine your credit limit is $500. That means the bank trusts you enough to lend up to that amount. If you go to a store and spend $50, you now owe the bank $50. If you later spend another $100, you now owe the bank $150. As you continue using the card, the amount you owe increases. Eventually, if you reach the credit limit, the card will stop working. The bank will not allow new purchases until some of the money is repaid. But something interesting happens when you repay the money. Your available credit increases again. You can borrow again. Then repay again. Then borrow again. This repeating cycle is why credit cards are called revolving credit. Now let us imagine a real situation in a store. You walk into a clothing store. You find a jacket you like. The jacket costs $60. You take your credit card and swipe it on the payment machine. The machine beeps. Within just a few seconds, the screen shows one word. Approved. But what actually happened during those few seconds? Behind the scenes, a complex digital conversation takes place. First, the payment machine sends the transaction information to the store's bank. This bank is called the acquiring bank. The acquiring bank then sends the information to a payment network. Payment networks connect banks all over the world. These networks help move payment information between banks. The network then sends the request to your bank. Your bank is called the issuing bank. Your bank quickly checks several things. It checks whether the card is real. It checks whether the card has been reported stolen. It checks whether you still have enough credit available. It also checks whether the transaction looks suspicious. If everything looks normal, the bank sends back a response. The response says approved. All of this usually happens in just 2 or 3 seconds. But behind those seconds are massive computer systems handling millions of transactions every day. Now here is an interesting question. Who actually pays the store? Many people think the credit card company pays. But in reality, your bank usually sends the money. Your bank transfers the money to the store's bank. The store receives the payment. The store is happy because the sale is complete. But now something important changes. You now owe the bank that money. The bank has effectively given you a small loan. Every time you use the credit card, you are borrowing money again and again. At the end of the month, your bank prepares something called a statement. The statement is a summary of everything you bought. It lists every purchase. It shows the total amount you owe. It also shows a payment deadline. The statement may also show something called a minimum payment. This minimum payment is the smallest amount you must pay to keep your account in good standing. At this point, you have a choice. You can pay the full amount you owe. Or you can pay only the minimum amount. If you pay the full amount before the deadline, something interesting happens. You usually pay no interest. That means you borrowed money for free for a short period of time. But if you pay only the minimum payment, the remaining balance stays on your account. Now the bank begins charging interest. Interest is the cost of borrowing money. It is how banks make profit from lending. Over time, interest slowly increases the amount you owe. If someone keeps a balance for many months or years, the interest can become very large. This is one of the reasons credit cards can sometimes lead people into serious debt. Now let us ask another question. Why do stores accept credit cards if banks take fees? Every time someone pays with a credit card, the store usually pays a small percentage fee. Part of that fee goes to the bank. Part goes to the payment network. Even though stores pay these fees, they still accept credit cards. The reason is simple. Credit cards make spending easier. When paying with cash, people often think more carefully about every purchase. But when using a card, spending can feel less painful. This means customers often buy more products. For businesses, that usually means more sales. That is why credit cards became so popular around the world. However, credit cards can also be risky. Because the money does not feel real when spending it. People can easily spend more than they can afford. If the balance grows larger and larger, interest charges can make the debt grow even faster. This is why financial experts often give simple advice. Use credit cards carefully. Spend only what you know you can repay. If possible, pay the full balance each month. When used responsibly, credit cards can actually be useful tools. They make payments fast and convenient. They can protect customers against fraud. Many cards also offer rewards such as cashback or travel points. Another important benefit is building a credit history. When people pay their credit card bills on time, banks see them as reliable borrowers. This trust can help them qualify for loans in the future. For example, someone who manages credit well may find it easier to get a car loan or a home loan. But the most important thing to remember is simple. A credit card is not free money. It is borrowed money. And borrowed money must always be repaid. So the next time you swipe a credit card, think about what is really happening. Computers are communicating across financial networks. Banks are approving a short loan. Money is moving between institutions. And a small piece of plastic is giving you temporary access to borrowed money. It may look simple from the outside. But behind that simple swipe is one of the most powerful financial systems in the modern world. And now you understand how credit cards actually work. You found this video helpful, make sure to subscribe. There are many more interesting videos coming soon. Videos that explain science, money, and everyday things in a simple way. So subscribe and join the channel. And I will see you in the next video.